All right, let's jump right into this. Welcome to The Explainer. Today we're taking a look at all those loud economic alarms ringing around us right now, and we're tracing them straight back to their source. We're talking about an unprecedented 15-year experiment run by the Federal Reserve. To figure out how we got here, we literally just have to follow the money. And for the last decade and a half, well, that money has been incredibly easy to come by.
Now, Warren Buffett has this really famous saying that honestly perfectly captures the moment we're in right now. He says, you don't find out who's been swimming naked until the tide goes out. And think about it. For 15 years, the global economy has been swimming in an absolute ocean of cheap cash. Borrowing was practically free. But right now, that tide is rapidly pulling back, and it's exposing some massive hidden vulnerabilities.
Section 1. An economy sounding alarms.
Okay, before we even look at Wall Street, we have to talk about Main Street. Just look at this number, 6.8%. By the fall of 2021, inflation had absolutely blown past the Fed's target of 2%. And yeah, officials kept calling it a transitory glitch, right? But for average Americans, it very quickly became this sustained, painful cost of living crisis that was just eating right through their wages and savings.
The disparity of this era is honestly just staggering. While everyday items became totally unaffordable for a lot of folks, billionaire wealth in the U.S. surged by $1.3 trillion during the pandemic. At the exact same time, in Phoenix, which actually had the nation's highest inflation, food banks saw demand spike by 26%. We're talking about lines 1,000 cars long. Families were literally forced to make the impossible choice between paying rent and buying groceries.
So this brings us to a really crucial question. How did a system that was fundamentally meant to stabilize and help the economy become so incredibly fragile and unequal? Well, to answer that, we have to go back and find the very first domino. Let's go back in time a bit.
Section 2. The 2008 Emergency Fix.
Back in 2008, to keep the entire banking system from just completely collapsing, the Fed dropped short-term interest rates essentially to zero. But amazingly, that wasn't enough. So they broke the emergency glass on a highly experimental tool called quantitative easing, or QE. Put simply, the central bank creates new money out of thin air to buy financial assets like government bonds. The whole goal here? Flood the banks with cash and artificially lower long-term interest rates to hopefully stimulate economic growth.
But here's the thing. What started in 2008 as this temporary break-the-glass emergency rescue, it quickly mutated into a permanent fixture. Just look at this timeline. By 2013, when the Fed even hinted at maybe slowing down the money printer, markets threw a massive fit. It's known as the taper tantrum. The financial system had basically become deeply addicted to cheap money. That addiction led right into the massive pandemic stimulus of 2020, and finally, the really aggressive tightening we saw in 2022.
The result of keeping rates near zero for so long was basically a massive sugar high for the markets. Quantitative easing severely penalized everyday savers and heavily favored borrowers. I mean, with safe investments like regular savings accounts yielding absolutely nothing, investors poured their cash into way riskier assets, and that sparked the longest stock market bull run in history, driven mostly by cheap money, not necessarily by actual business innovation.
Section 3. Building the no-lose casino.
So throughout the 2010s, we saw this massive disconnect play out. The Fed's hope was that companies would use these super low borrowing costs to take on debt, hire new workers, build factories, and invest in real-world infrastructure. But the reality? Well, it was a lot easier for companies to issue cheap debt just to buy back their own stock. Over a single decade, companies spent over $6 trillion on buybacks. That artificially boosted their share prices and enriched executives, rather than actually improving their businesses. Billionaire investor Howard Marks hit the nail on the head when he described the moral hazard this created. He said, "If you aggressively play and fail, you'll get bailed out. It is a no-lose casino." And that's exactly how Wall Street felt, completely emboldened to take on massive risks. Because hey, if they won, they kept the profits. And if they failed, they figured the government would always just step in and save them. And you could see the unintended consequences of this era literally everywhere. Private equity firms use this cheap debt to buy up huge swaths of the economy. We're talking everything from residential housing to hospitals. Risk migrated away from heavily regulated banks and straight into unregulated shadow banks. Plus, out in Silicon Valley, cheap cash was fueling these unicorns like WeWork, companies that were somehow allowed to disrupt entire industries without the pesky requirement of actually, turning a profit.
Section 4. The pandemic money flood. Then we hit 2020. When a global shutdown threatened total economic collapse, the sheer scale of the rescue was mind-boggling.
Congress passed the $2.2 trillion CARES Act, sure, but the Fed also unleashed its own bazooka. They were pumping $120 billion a month into the economy, and even began buying up corporate junk bonds just to keep highly leveraged companies afloat. So what happens when there's just way too much money sloshing around in the system with nowhere to go? You get what analysts started calling the everything bubble. It was pure mania, right? We saw historic real estate booms, millions of people pouring their stimulus checks into crypto, and those totally unprecedented meme stock surges like GameStop. Tech company valuations were hitting multiple trillions of dollars. It was this huge wave of speculation that was just completely detached from economic reality.
Section 5. The tide goes out.
Now, looking back at this 15-year experiment, there was a really sharp debate going on. On one side, you have Fed officials like Neil Kashkari defending the policy. They argue that prioritizing maximum employment actually helped the poorest Americans find jobs and really boosted wages. But then you have critics like former regulators Sheila Bair and Thomas Honig arguing the exact opposite. They say the policy fueled massive wealth inequality, penalized everyday savers, and built a dangerously fragile, debt-laden system.
But honestly, regardless of which side of the debate you fall on, the mandate eventually became crystal clear. Inflation simply had to be stopped. In August 2022, Fed Chair Jerome Powell made this incredibly stark pivot. He said, "These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain." That was it. That was the definitive signal. The 15-year era of easy money was officially over. To fight this inflation, the Fed didn't grab a scalpel. They brought out a sledgehammer. Step 1, halt quantitative easing, turn off the money printer. Step 2, aggressively hike interest rates at the fastest pace we've seen in decades. And Step 3, intentionally slow demand. This is a very blunt instrument. It raises borrowing costs to discourage spending, and it makes businesses quite literally not want to hire, cooling the economy down by sheer force. But, as you can imagine, suddenly withdrawing the cheap money that the entire system had relied on for over a decade caused immediate, systemic shocks. The bubbles popped. Silicon Valley Bank collapsed. The housing market was essentially pushed into a deep freeze, and a brutal crypto winter arrived. And worse still, everyday workers saw their 401ks and pension funds suffer massive double-digit losses. All those hidden vulnerabilities we talked about earlier, totally exposed.
So the core takeaway from all of this is that we are living through a true, once-in-a-lifetime financial transition. The global economy was built around 0% interest rates for over a decade, and right now it is fundamentally and painfully restructuring itself to survive without that 15-year life support system.
Which leaves us with one final, really provocative question to think about as we wrap up. If the era of easy money is truly over, who ends up paying the final bill? Are the highly leveraged players on Wall Street going to bear the brunt of this economic hangover? Or is it ultimately going to fall on the shoulders of everyday working Americans trying to navigate a tightened economy? It's a question that's going to define our financial future for sure. Thanks so much for joining me for this explainer, and I'll see you next time.